Okay, we are live.
Thank you, Philip. I'd like to call to order this meeting. I believe it's a regularly scheduled meeting of the Kentucky Retirement Systems Investment Committee. And we'll proceed to an opening statement from Ms. Hale.
Yes, sir. For the record, I want to note that this is a regular meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Could we have a roll call, please, Sherry?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins, Miss Bova,
Here.
and Miss Thompson.
I don't believe she's going to be joining us. She has, I know she has a board meeting because I have friends in it, and it seems to always coincide with some of ours. So
Yes, she had told me that.
Yeah, I'm going to make their board change theirs. How's that? I'm sure they'll listen to me. But I think she's the treasurer investment chairman of it. But anyhow, so at this moment, we don't have a quorum. Is that correct?
That is correct. I did reach out to Mr. Atkins, but have not heard back from him.
Yeah, maybe he is a person of wisdom. Maybe he's in Florida on the beach. But also maybe he'll call in. So
Mr. Lane?
Yes.
I'm sorry, I just need to correct. The opening statement that I read said that this meeting could be viewed at the Kentucky Public Pensions Authority offices. It cannot be viewed at that because the governor has closed all offices. So I wanted to correct the statement in saying this meeting is just being broadcast via video teleconference and can be viewed on Facebook.
Thank you. Do we have any public comment?
No, sir. No public comment today.
All right. I believe everyone has a copy in their books of the November 21 and December 17th board meeting or investment meeting minutes. Any corrections or comments that we need to add to that? Hearing none, I'll look for a motion to approve the meeting notes.
Well, sir, without a quorum, you can't vote on the meeting minutes.
Correct. I wanted to be a loser there. So,
sorry.
hopefully we'll get another chance at that. And we go down the agenda. My agenda is not going down. Scrolling down. What is our next item here we go. It's just slow. It's in the cold weather. The next item is the investment review and update. And I would like to make one probably comment I should have made earlier. I spent some time, more time than usual, reviewing because it was the year in the report that Joe prepares. I got to say it is exceptional. It really is he does a great job. I know we get some help in some areas too. But when I joined the board, it was somewhere between useless and illegible. And now I find it's very useful and quite informative. And so I'd like to compliment the staff and Joe in particular for.
Well, I appreciate that, Mr. Lane, but all asset class heads kind of do their own commentary, and Steve Willer does a lot of the lifting and the aggregation. So I can't take as much credit as you're trying to give to me, but I appreciate it. If Steve wants to share some of it, we'll take it.
Well, I knew that you got a little help there. But
no, it's a group effort, and I think I appreciate that, Pruitt. And I think we've come a long way from trying to balance information and not make it too much of an overload of words. Tried to add some visuals to it and really give what's influencing the performance of the portfolios. And hopefully, we appreciate the feedback, and any suggestions anyone has, we're certainly willing to consider those.
Well, let's see, you still have the floor.
All right. Well, we do have a very full agenda today, and hopefully get an opportunity to vote on some investment recommendations that we're very excited for. So I wanted to briefly have Wilshire cover kind of the economic conditions and market overview for the second quarter of the fiscal year, the fourth quarter of the calendar year, and then I'll briefly cover some performance and allocation, and then we'll jump right into the recommendations. So Wilshire.
Thanks, Steve. Hi, everyone. Also with me from Wilshire is Craig Morton and Mark Friedberg. And as Steve suggested, we'll go quickly through this. Sherry, if we could jump, please, to page 11. I'll make probably one more plug for our conference if anyone would like to attend that. Out on the West Coast, April 8 and 9, you'll hear from all kinds of us at Wilshire and lots of research and et cetera, et cetera. So if anyone has interest and hasn't tried to sign up for that, please do, and reach out to us if you have any trouble with the link or where everything is or anything like that. Happy to have anyone join that. I think we'll go just in a minute to, well, you could go now, Sherry, I suppose, over to slide 14, but I was going to start with just 2024. The story of 2024 is primarily U.S. equity, and you're going to see this as we go through comments that Craig makes and Steve's report, et cetera. Just a period of continued resilience in the market. 2024 returns of about 24% to the U.S. equity market, followed coming off of the heels of 26% or so in the prior year. So you can think about assets invested in the U.S. Equity market have increased by about 50% over a period of 2 years. Really strong equity market. We go from there and look at rates, and here on slide 14 is the story of rates, and therefore the story of bond returns for the year. And I'll just take the top part of this chart and looking at the nominal 10-year, which ranged between essentially 4 and 4.7. If you track the 10-year, that's the kind of activity you saw throughout the year. And as rates are going up, bond returns are going down. As rates are going down, bond returns are going up. So it's pretty well represented graphically here as to what the year looked like. We ended the year with in terms of aggregate bond index, just investment grade core bonds, of a little over a 1% return. So not a whole lot of excitement out of those movements and rates. I will say other parts of your portfolio, much stronger returns. You'll see a lot of that high yield, for example, looked more like equities in a sense, with returns of over 8% for the year. So much different story there, but really a flat year for bonds, and rates kind of jumping all over the place. If we just go one slide further to 15, we show here debt and deficits. And this is, of course, all over the front pages, the middle pages. This is everywhere right now in our political environment, new administration, geopolitical issues. We have debt. We have a high level of debt. We have strong deficits. But what's interesting, and that's a big political story. Somehow the market has managed to shrug most of this off. When we talk about the returns we just had in equities, this hasn't frightened investors. It just hasn't. We've had strong returns in equities. We've also had strong things driving those returns, like consumers spending money, GDP being positive, and corporate earnings being strong. So kind of two different stories going on there, but this just gives you a picture of what that looks like historically and where we are with it today. Let's go out to 18, please. And I'll just touch on, so where does that take us when we look forward in terms of expected returns over the next 10 years? And we've talked about this in each of the last 4 quarters. In our projections, we have what we refer to as a negative equity risk premium, meaning that we expect over the next 10 years to be paid less for stocks than we are for bonds, at least here in the US. And if you look at these green highlighted areas, we're showing the change in our assumptions from the end of the last quarter to the end of December. So 1 quarter movement, but a forward looking of 10 years. And if you go down that December 24 column about halfway, you see core bonds at 5.2%. That's a reflection of where these rates are today. And right now we're still hovering around 4.5, 4.6 on a 10-year treasury. So you add some spread to that from investment grade product, and you have over a 5% expected return for core bonds over the next 10 years. Below there in equities, you'll see US stocks at 4.35. They've actually up just a little bit from the end of last quarter, but that negative equity risk premium is actually stronger because rates are up further. We expect more out of bonds looking forward than we do out of stocks over this 10-year period. So that's a challenging thing to think about. You have a lot of other very productive asset areas in your portfolio, from private equity to private credit to real assets, high yield, et cetera. So there's a lot going on. It's not that you need to be too caught up in this, but just want to show that expectations for equities in general, publicly traded equities, are low, and particularly in the US. And if you just think about the valuations we come off of, there's plenty of reason for that. And just to give one more bit of history on that, if we go over to page 19, the next few pages, I won't go through all of these, but this is kind of some fun work that we did on decades. And while decades really are just a particular calendar point in time, they are what a lot of investors think about and refer to. And so just to give a picture of that, these are decades all the way back to the 1970s. We see this is the growth of assets invested in US stocks. And we see 1980s and 1990s with up around 400% total accumulation, total growth in those areas. Those 2 decades, very strong. But we can have decades like when we talked about this forward-looking forecast of 4.35 today. If you look at the bottom of this chart, we also have periods where we refer to a lost decade. And the 2000s were essentially that. The green line at the very bottom is the return on stocks for the decade of the 2000s, which landed at about 0. So it does happen. You can find all kinds of other points of this depending on where you start the measurement and where you end the measurement, but these are your typical calendar year periods. And I just point that out because sometimes it's hard to imagine that we would actually forecast a negative equity risk premium, but it is possible when you look at current conditions and valuations. And one more piece I'll add to this, if you look at where the bubble is in the middle, the 2010s, so that's the more medium blue line, that decade produced about a 250% cumulative return to stocks over that period. And then we stepped into the 2020s. We're 4 years into this decade, and that's where you find right in the middle of that bubble, there's a dark blue line that has grown up to about another 100%. So when you think about looking forward, could we get there? Could we have low returns to equities looking forward? Yes, we certainly could. And valuations, suggest that quite a bit. But also when you look historically, you can see where that has happened. And I'll give just one more highlight to this on the next page. Counterpoint to this are bond returns to bonds over various decades. And just pointing out at the bottom, here's our 2020 decade, almost halfway through. We all know that bond returns have been flat. And this is the case as we had rates go down near 0 and then back up strongly. We've had a 5-year run on bonds that has actually been negative. So you can see that in bond returns that can happen as well. Right now, the counterpoint is low expected returns out of equities looking forward, better expected returns out of bonds looking forward. So I'll just stop there, and there are more of these charts. You can look at it at your leisure, but I think Craig will make a few points further in this next section, and then we'll go back to you, Steve.
Thanks,
Hey,
Dave.
David, I have a quick question. I have a quick question. Sorry, I jump in. I
Sure.
think those are great perspective charts. Have you guys done any work on, I know, we especially in fixed income, we talk about, few expected returns are going to be based on current yields or valuations. Have you guys done any like cohort starting point 10-year forward returns based on current valuations? That would be an interesting chart to see. I know there's a lot of different metrics. Obviously, in fixed income, it's yield. Your starting point, where your
Sure.
yield, what your 10-year returns are going to be. But that would be interesting to maybe add another layer to that historical perspective of the starting point is really important to
Oh,
your
absolutely,
forward
Steve.
expected returns.
Yep. Yes, we have done work, and that's a really great point. These are convenient calendar decades, but it's the rolling data is always more exciting to me because I find these periods where you get the start and the stop just sort of either really right or really wrong, and you see some dramatic results. Yep. Happy to come back with any of that.
Thank you.
I'll start on page 25, and I'll just hit a few pages here on some of these economic factors that we regularly report in on. So starting with GDP, fourth quarter, the advanced estimate came in at 2.3%, so lower than the previous 2 quarters, but stronger than the first quarter. So the year is kind of bookend by 2 slightly weaker quarters, but a stronger middle of the year. So based on that advanced estimate, that would give us a 2.8% real GDP number for the year, down from 2.9 the year before, so relatively unchanged year over year. Then the fourth quarter was GDP growth continued to be fueled by the consumer, up over 2.5%, hurt by exports and investment, which declined quarter over quarter. The price index that's used to come up with the real number here was up 2.2% for the fourth quarter versus 1.9 for the quarter before. So as we move to inflation in a bit, you'll see that inflation stepped up in the fourth quarter and into this new year. So that weighed on this real GDP reading. On the next page, we'll turn to the consumer. And we've seen here at the top chart, you can see consumer confidence has been steadily creeping higher the second half of last year. It's been a choppy ride for the last 3 years since bottoming out in 2021, but moving back towards that 10-year median line for the consumer. The consumer condition is really a mixed bag. You can see consumer confidence here has been trending higher, but surveys of consumer confidence for the future indicate that the consumer is a bit more leery about what's coming than they are confident about today, which has historically been a bit of a potentially self-fulfilling prophecy where if you're leery about the future, you might change your actions to be more cautious today. So on the positive side, the consumer has strong current confidence. Their savings rate has grown in recent periods, and wages were up roughly 4% year over year, so giving them a bit more ammunition to go out and spend. But on the other side, they're dealing with stubborn and slightly rising inflation, persistently high interest rates, and they've depleted their excess savings that was built up during the early days of COVID over recent years. So the consumers, I'd say, pretty finely poised, could move either way from here. They have some things working in their favor, including a pretty strong jobs market, and some things working against them. So if we move to the next page, business activity, you can see in the dark blue line in the top chart that we've been in a manufacturing slowdown based on the ISM PMI reports. That number actually ticked positive for the first time since 2022 here in January. So right around, I believe it was 50.9. So still right around that middle inflection point, but a bit of positive news from a manufacturing perspective. And you can see the light blue line, services, has been positive for some time now, and that's again something that we see reflected in the inflation information. That services is where people have been spending their money for a few years now, since lockdown rolled off and people were eager to get back out there and live their lives again. So I'll end on page 28, inflation and employment. So inflation, like I said, has ticked up in the fourth quarter. We saw month over month readings from October through January, 0.2, 0.3, 0.4, 0.5%. So that gives us a 3% roughly unadjusted rate year over year. That I'm sure everyone on this call is aware is is ties into the political environment, as David mentioned, a new leadership and kind of conflicting messaging, but also objectives. You know, tariffs would be inflationary, but obviously the Trump has indicated that he'd like to see lower rates. The employment picture has been strong, but at the same time, we've got the Elon and the Doge team potentially cutting a handful or more of government jobs. So again, sort of like the consumer I mentioned is kind of poised on a knife's edge. Some of these other factors, inflation and employment in particular, are also kind of finely poised and could move in either direction going forward here. But it's interesting to point out from the employment picture, although January was a bit of a softer reading, November and December were very strong, and we've seen unemployment now since October of 2021 trading kind of moving around in this 3.5 to 4.5% range. So right at the precipice of full employment, and even if current hiring has slowed down, so have terminations, and the employment rate has held up pretty strongly. So the employer or the prospective employee is not as strong as they had been, because we've seen a decrease in the number of openings versus the number of people seeking jobs, and that's kind of returned to more equilibrium, but still a relatively strong employment situation. So promised I'd try to be quick, so I'll wrap it up there and not get into the different economic segments, because I'm sure Steve will touch on that as he moves through your portfolio.
Well, thank you all. That was a good report, and it certainly hit the highlights. I have one editorial comment that I occasionally have opinions, as some of you know. I've read a couple of articles over the holidays about what in the world is the 2% target that the Federal Reserve has. It's very interesting that even going back to people that were in the Federal Reserve or the Treasury, that would not as important, nobody knows. It is not academically been proven that it has anything, but the Fed staff economist, it seems, just chose it as a number. And there is some thought that it's just too low, that it is not what accompanies a strong economy, a good economy, not necessarily one that's just robust. But so when I hear that, well, we haven't gotten to the 2%. While I'm a big fan of what our chairman of the Fed is doing, I think they sometimes don't look at the right numbers or look at them in the right way.
Mr. Lane, I did want to announce that Mr. Atkins did join the meeting during the presentation. So I will notate his attendance.
Thank you, Dave, for joining us, and we'll let Steve pick it up from here.
Thank you, Sherry. Page 42. Good morning, everybody. As Wilshire did a really good job of covering, a good overview of the economic conditions and market performance for the fourth quarter. And as I mentioned, I will try to be brief as we have some investment recommendations that we're excited to present to the investment committee. Even though Dave Eager always told me I talk too much, so Sherry, give me a wave if I'm going too long here. But so not only did the year, as Wilshire mentioned, see bookend performance, but so did the quarter. We had poor performance to start the quarter, strong in the middle, and then poor at the end of the quarter as well, with risk markets struggling in December, failing to build on what was called the Trump bump following the U.S. election that saw markets surge in November, especially segments seen as beneficiaries of lower taxes, regulatory rollbacks, and protectionism. Accordingly, the portfolios ended the quarter giving up some of their gains they achieved during their first quarter of the fiscal year. The KRS pension composite produced a return of minus 0.83%, underperforming the blended benchmark return of minus 0.23%. The KRS insurance composite produced a return of minus 53 basis points versus the benchmark return of positive 27 basis points. The KRS pension portfolio returned minus 88 basis points, while the SPRS pension portfolio returned minus 97 basis points versus their benchmark return of minus 34 basis points. The KRS hazardous pension portfolio produced a return of minus 51 basis points, and returns for the insurance portfolios range from minus 34 to minus 62 basis points, all compared to the benchmark return of positive 27 basis points. During the quarter, the real return and specialty credit portfolios were the standout performers, as evident on the performance charts here, posting positive returns and outperforming their benchmarks by 278 and 101 basis points, respectively. Importantly, fiscal year to date, the KRS pension composite has produced a return of 4.36%, outperforming the blended benchmark by 15 basis points, while the KRS insurance composite produced a return of 4.33%, versus its blended benchmark return of 4.75%. January performance is still preliminary, but with risk markets rebounding sharply, the portfolios are indicated up 250 to 300 basis points for the month. U.S. equities in January were up 3%, with a rotation and broadening in the markets that saw small cap outperform large caps and value outperform growth. Global equities were up about 5%, with European equities broadly outperforming. We also saw core fixed income, high yield, and loans all producing positive performance, up between 50 and 150 basis points as yields fell modestly. For 2024, as Wilshire mentioned, markets really grappled with numerous headwinds and unknowns, from elections, geopolitical risk, uncertain fiscal policies, and that uneven normalization of inflation in the labor markets. That all really combined to keep fears of recession and stagflation elevated. And despite that, equities performed exceptionally well again for the second consecutive year. Uncertainty should remain high in 2025, and risks are seemingly asymmetric as markets react to policy shifts and economic data, underscoring the reality of what is really a new macro environment we're entering. And we view that as having a wider range of possible outcomes and persistently high volatility that we've already seen so far in 2025. The best way to describe the current state of the market mood, I think, is something I'm taking from someone else, but and the market mood and the confusion around Trump policies is the acronym T2D2. So a little bit like Star Wars: tariffs and taxes, along with deregulation and deportations. The scope and reach of timing for all policy shifts matters to the markets and how the economy will play out forward. And so that's what we think is going to keep markets elevated for the balance of 2025. Page 44, please, Sherry. Thank you. This should look familiar. This is the second time we shared this report, and it's highlights the performance of the internally managed portfolios. This was requested by the investment committee and the board, and so we just put this performance report together. The majority of these assets are managed passively and intended to provide inexpensive beta exposure to what we view as the more efficient markets, while providing staff flexibility in rebalancing the overall portfolio asset allocations. Additionally, as we're aware, staff manages a number of proxy portfolios, which serve as transitional positions for alternative, less liquid asset classes, as capital is committed, is called by managers, and staff sources new investment opportunities. As you'll see, the real estate and real return proxy portfolios produced negative performance during the quarter, which is consistent with the broader markets and their liquid investments. Longer term, all of these proxy portfolios have produced strong relative performance, contributing positively to the overall portfolio performance. The internal public equity and core fixed income portfolios performed in line with expectations, producing index-like performance, with the exception, as we noted, of the scientific beta portfolio, which not to put Joe on the spot, but we'll be covering in more detail as part of the investment recommendation. 46, please, Sherry. Performance attribution. So across portfolios, the largest contributor to outperformance relative to the benchmark during the quarter was, as we mentioned, the outperformance in the specialty credit portfolio. And that is as managers produce positive excess performance across the board. So it was a very strong quarter, both on an absolute and a relative basis for all of our specialty credit managers in the overall portfolio. The specialty credit portfolio produced a return of 2.26% for the quarter compared to the blended benchmark return of 1.22%. And over the last 12 months, this portfolio has outperformed its benchmark by 263 basis points. For the quarter, relative underperformance in the private equity portfolio compared to its public market benchmark was the largest driver of underperformance, as this portfolio trailed its public market benchmark by 613 basis points during the quarter. This has been something we've talked about at length at investment committee meetings. This underperformance accounted for between 50 and 75% of the total underperformance relative to benchmark for all of the portfolios during the quarter. This is not unique to our private equity portfolio. Private equity markets have broadly produced positive returns, but the short-term performance for all alternative asset classes have lagged the sharply rising U.S. equity markets. As Wilshire said, it was another strong year, with the S&P and Russell 3000 both gaining over 35% for the trailing 12-month period ending 9/30/2024. Again, all of those performance numbers are lagged. The benchmark is lagged one quarter for private equity. Our private equity portfolio produced returns in line with this broader private equity markets, which were indicated up about 2.2% for the quarter. We're in the process of evaluating potential alternatives or additional performance benchmarks for this asset class, which we feel would better reflect the actual investment opportunity set, and hope to bring a recommendation to the committee at the next regular meeting. The global public equities returned minus 1.55% during the quarter versus its benchmark return of minus 99 basis points, which also contributed to the total fund's underperformance. The portfolio's non-U.S. equity tilt drove underperformance as these markets underperformed the U.S. markets by over 10% during the quarter. And our performance was also hampered by our overweight to small caps relative to the benchmark. Drilling down for the quarter, our U.S. public equity portfolio returned 2.5% versus its benchmark return of 2.63%. The non-U.S. public equity portfolio returned minus 7.8% versus the MSCI ACWI ex-US index's return of minus 7.61%. For the last 12 months, the global public equity portfolio has returned 15.22% versus its benchmark return of 17.49%. Part of that underperformance in the global public equity portfolio has been the result of a mismatch between the composition of the benchmark and the actual portfolio. And this is something Joe's going to discuss later in the IPS performance benchmark recommendation he's going to bring to the committee. Page 58, please, Sherry. Thank you. While the portfolios performed well in absolute terms, as expected, given their lower overall risk profiles and lower allocations generally to public equities, which were the best performing asset class, they've underperformed from a broad peer perspective over the last year. Again, a year where U.S. public equities hit multiple all-time highs. The lower risk profile of the funds is evident in their standard deviations relative to the peer universe shown in those middle graphs. And in the graphs on the far right, you can see all of the portfolios have continued to deliver top decile or top quartile risk-adjusted returns over longer periods of time, and really demonstrating the efficiency of their construction and management. So that's something that we keep an eye on. That's something that we really work to achieve, and we think is important for all of the systems. Page 70, please, Sherry.
Steve, could I add a point to
Absolutely.
I just note that on the first panel to the far left, the return over 3 years. We talked earlier about these strong equity markets the last 2 years, up 24%, up 26%, and then the prior year, down somewhere around 20%. Just hugely volatile, crazy equity markets. Interesting to see that you have a lot of diversification, a lot of other things happening. And in that period, in that 3-year run, you're 16th percentile. So you've performed better than 84% of these other funds. The median fund in this database was 2.7 annualized, and you were 3.85. So I think just to emphasize your point about your diversification and the structure, et cetera, you've really fared through that highly volatile yet strong returning market in a really good way.
Absolutely. I appreciate that point. And I think that that's great to emphasize. Our portfolios are built for diversification and to kind of minimize that volatility as we see in the middle graphs. And those all come together in that Sharpe ratio, which that, the risk adjusted return, which all of the portfolios have performed very well. Page 70, please, Sherry. Thank you. As of the end of the quarter, all asset classes for each portfolio were within the IPS specified ranges, with the majority of the positioning within 1%. So over the last year, given the changes in asset allocations that were provided in the investment policy statements, we've done a lot of work, moved all of the portfolios, and we feel like we're really at a very good spot with our allocations. We continue to work daily, both on sourcing new investment opportunities as well as monitoring and reviewing the current investments in the portfolio. Some of that's going to come to the front with the recommendations we see later in the presentation. And during the quarter, we took opportunities to reduce the overall overweight to global public equities as we rebalanced exposures. But we've maintained a modest overweight of approximately 150 basis points across portfolios. And that's largely on that continued market momentum that we've seen, as well as David mentioned, the economic strength. In the core fixed income portfolio, we're currently neutral overall duration. As you may remember, we were short when rates were near the zero bound. We've neutralized that short duration position. And it's difficult right now, as David mentioned, with 10 years of trading within a pretty tight range. We expect that to continue. It's difficult to have a high level of conviction and a compelling case to implement an active duration position within the portfolio. We're anticipating that range-bound trading environment over the balance of the year. As we start to see opportunity, we may look to implement a small short or a small long in the duration, but right now it's difficult to make that call. As managers have called and deployed capital in the real return portfolio, we've unwound the liquid proxy positions to fund these investments. And Anthony will be presenting a real return investment opportunity later. And we're in the final evaluation stages of a few additional opportunities that would allow the portfolios to fully unwind their proxies and reach their target allocations by the end of the fiscal year, which would be great. We'd like to have that capital deployed to active mandates, and remove all of the proxy positionings, although they've performed well and in line with expectations. The largest underweights continues to be in private equity, and that's been our structural positioning as staff has viewed the asset class as having limited value from a relative risk reward basis, with better opportunities available in other asset classes. We have begun focusing more on that asset class, as we've seen with the performance of the underperformance of the asset class and the funding difficulties. We think have really created potentials for a more attractive landscape. So we could be entering a period where these vintage years are certainly more attractive and would contribute positively to the overall performance of the portfolios. I'll pause there for questions. I said a lot. If not, we can jump into the investment budget on page 111, please, Sherry. Thank you. Through the first half of the fiscal year 2025, actual expenses were in line with the amount budgeted. That's the first time that's occurred in a while, with a total of $6 million or 48% of the budget spent year to date. During the quarter, we saw a significant uptick in overall legal expenses as activity increased for a number of ongoing cases, as we're well aware. And as these cases continue to move through the legal process, we expect these legal expenses will remain high for the remainder of the fiscal year. But we believe we've budgeted appropriately based on our expectations of the ultimate costs. Page 114, please, Sherry. Through the first 2 quarters of the fiscal year, investment fees and expenses across the pension and insurance trust were 31.1 or 32% more than in the same period last year, while total assets have increased 11%. For the period, base investment advisory fees increased 5.9 million or 15% more commensurate with the increase in the asset base. The most significant drivers of the increase in overall fees and expenses were the rise in the expense category line item, which includes those mandates and managers that use lines of credit as part of the strategy. And those expenses increased 6.7 million or 20%. Also, we saw an increase in performance fees, which have risen by 15.6 million across specialty credit, real estate, real return, and private equity. We also saw, as noted before, the $3 million increase in administrative expenses, which is largely attributable to those increase in legal expenses. And so taking those categories account for over 80% of the total increase in fees and expenses. We focus more on that investment advisory fee line item, which are the base fees that the systems pay to external managers. And I would note the consistency across time with a 25% increase in fees since fiscal year 2021, which is commensurate with a 35% increase in the total assets during the same period. Currently running at about 31 basis points for the total portfolio. Performance fees are running about 26 basis points at a total portfolio level, and expenses are at 34 basis points for the total fee level at the total portfolio level. We continue to see the benefits of restructuring of the core fixed income portfolios, with the investment advisory fees increasing only 3% year over year, while assets have increased 39%. And the core fixed income fees are also lower than for the same period in 2023, despite a 56% increase in assets. I'll pause there for questions.
Just the usual reminder for that performance fees are a good thing.
Yeah,
or a rise in performance fees. That means we're making more money, and of course our managers make a little bit more too, but that's a good thing.
Given the participation nature of performance fees as well as the hurdle rates for all of our mandates, which we work hard to make sure those are appropriate for the asset class and the environment, you're exactly right. I mean, we're participating. We get the bulk of that performance in our returns and pay some of that out to the managers in a performance fee. So yeah, I'm not unhappy to see increases. We work hard to make sure that there is negotiate as hard as possible. But obviously we like the participation aspect of that.
And it will be interesting to see in the political arena where taxation of
carried interest goes.
Interest goes, which is what, of course, the managers call it as carried interest, and they get capital gains treatment on that, and would prefer to stay at capital gains rather than at the full tax rate.
That will be interesting, and that could certainly change the dynamics of the market.
They just need to, I think those managers need to spend more time at Mar-a-Lago.
I'm sure they have invitations, right? Well, with that concludes my part of the presentation, and I will turn it over to Joe for the next section.
All right. Well, thank you all. Sherry, I don't know. I think it's 118 in the book for the recommendations here. Appreciate everybody's time this morning. KPPA staff and Wilshire are recommending investments for all KRS and SPRS portfolios in 2 actively managed U.S. large cap mandates to be managed by J.P. Morgan and T. Rowe Price, pending successful investment management agreements. Sherry, if you want to go on to the next page. The primary funding for these investments are going to be coming from the retirement of the internal U.S. large cap factor-based portfolio, which Steve pointed out as scientific beta. Secondarily, funding would come from the internal S&P 500 portfolios. It's important to note no placement agents were involved with this search, nor will any be compensated as a result of the recommendation. Sherry, if you'll move to the next page for me. As staff and consultant work to improve the structure of the global equity portfolio, we decided it was best at this time to terminate that existing U.S. large cap factor-based portfolio, which is the scientific one that Steve had pointed out. Though he said he wasn't going to put any spotlight on it, he did call me out by name. But unfortunately, that strategy, while it has performed the way we would expect it to, the factor tilts that it seeks to exploit, such as being a little bit smaller, leaning a little bit more value, a little bit lower in volatility, those things just While they've had a few short runs while it's been in our portfolio, it's never been able to have any kind of sustained success. And so we're viewing it as this is a time to kind of exit that position. While tactical tilts can serve their purpose in asset management, we don't want to introduce this structural bias any longer. It opens you up to sustained periods of potential headwinds, which is what we've experienced. At the same time, we did experience a little bit greater tracking error with the product than we expected. So, like I said, we just feel it's time to make a change there. We want to see our performance driven by stock selection rather than those structural biases that I mentioned. Um, we would prefer to add value by utilizing lower tracking error, active management. They come with reasonable fees, given the exposure and the relative outperformance that we are expecting. And so this presentation is really just a report to serve as a review of the competitive search process we went through. We believe that it aligned with the IPS and with the procurement policy. Sure, if you'll go to the next slide for me. This is just a real high level review of the general process. We started with the Wilshire management database. It's got over 12,000 strategies in it. We applied a minimum criteria to cull that list to something that's much more manageable for us. Staff did reserve the right to add in managers that might not. I guess it's important to note that that database is self-populating, so there's some managers that don't participate that we've met with that are interesting, and so we reserve the right to add those into the search process. From there, we do additional cuts, typically quantitative in nature, to kind of funnel those potential options down to something that's more manageable. Once we get to that shorter list of candidates, we provide a request for information from them. Staff and consultant review those RFIs independently from one another, and then get together to discuss, pros and cons of each potential option. From there, we did get down to a short list where we went on site, had further discussions with the investment teams, further discussions beyond those points as well. Sherry, if you'll slide over some of the initial screening criteria here listed. Obviously, we wanted to see large cap strategies. We wanted to see meaningful size as far as the amount of assets ran in those strategies. So firms of 10 billion or greater, strategies with at least $1 billion in them. We wanted to see at least a minimum 5-year live track record of managing monies within that strategy. The firms and teams that we looked at needed to have a third decile or better ranking from Wilshire's manager research team. Relative returns, we obviously want to see positive excess across 1, 3, 5, and 10. Tracking error needed to be at least 1%, so that it was meaningful enough to justify having that active manager and the fees that come with that. Information ratios, we wanted to see at least as a 0.5 or better for those same 1, 3, 5, 10-year periods. The Sharpe ratios, wanted to see positive excess, and then the up-down capture ratios. This is just kind of a measurement of market participation. We wanted to see above 1 on the upside, below 1 on the down. And Sherry, if you'll come over, there you go. The preliminary screening that we briefly mentioned gave us a list of about 111 options to look from. The additional screening and culling brought us down to 7 firms, 9 different strategies for receipt of that RFI. From there, we kind of got down to our short list of those 4 you see listed: BlackRock, Columbia, JP Morgan, T. Rowe Price, for those on-site visits and further discussions with management. Then if you'll slide for me one more, JP Morgan, we're recommending them, founded in 1863, publicly traded firm. They manage roughly a little over $1 trillion in public equities. The particular strategy we're looking at's got about 82 billion involved. It's kind of your traditional team setup, and where it does say there's 3 PMs, really there's a lead PM with some backups there, but they all are very experienced, 25 years on average with the investment industry, 19 with JP Morgan. They're supported by a team of 18 career sector specialists that are just as experienced. You'll see 23 years in the industry, 12 with the firm. And I didn't note on this page, but there are a secondary level of what I guess you would view as more junior people supporting those career sector specialists, but really they're pretty have a lot of experience as well. They average about 7 years investment experience. The lead PM is ultimately responsible for all the buy sells, for the portfolio construction, for the risk management. Um, from an investment philosophy perspective, the team really seeks to understand normalized earnings power of a company, and then they try to take advantage of any mispricing from near-term information that might occur. They believe their information advantage comes through their developed through their proprietary fundamental research. They really believe stock selection in the context of a high conviction, fully invested, broadly diversified portfolio that's style consistent is how you can add value over time. If you'll slide for me one more. Um, they try to create a sustainable proprietary information advantage by leveraging those fundamental analysts. Like I said, they're very experienced, 20 some odd years in the industry on average. They look to seek to gain an understanding of the dynamics of the business, its growth prospects, the sustainability of any competitive advantage. So they're looking at things like how capital intensive is the business, what's the cash flow generation, what's the balance sheet strength, return on capital. They look into the governance as far as shareholder focus. Is the management competent as far as how it allocates the capital? So very in-depth fundamental research there. From there, they move to utilize a systematic valuation process to quantify their forward-looking views. This really comes down to being able to forecast longer-term earnings and dividends. They are not necessarily interested in what's the next 12 to 18 months looks like. They typically are more involved looking towards that 3 to 5 year mark, trying to determine what a normalized long-term earnings looks like and whether the current price is over or undervalued based on that, which is where the opportunity presents itself. While they're doing this, each stock's characterized into an industry sector and they're ranked into quintiles. This chart on this kind of shows the success of their ranking of that fundamental research, how powerful it is. This is since inception, annualized performance. Those first two quintile rankings have been able to add value over the index, while quintile 5 is obviously underperformed. So this shows that they've been able to effectively use that fundamental research to project what they think is going to be the winners and losers. You'll slide one more page for me, Sherry. Ultimately, they can try to construct a portfolio that's based on stock selection while concentrating risk on their highest conviction ideas. The PM is going to select from the most attractively valued stocks within each sector. Typically, they're looking at those top two quintiles. It does not mean they won't own something in the 3 or 4, sometimes names in certain sectors, even though they might be ranked third or fourth quintile in that sector, can still be more attractive than a first or second quintile in a different sector, given the market environment at that moment. So they're not exclusively holding the top two quintiles, but they do skew that direction. The ideal holding is going to be attractively valued, where the insights from the team are differentiated from the street and that their conviction's high, where there exists a compelling risk-reward relationship. The portfolio is typically going to have 50 to 70 names with tracking error somewhere in that 2 to 4% projected. Historically, it's been a little on the lower side of that, more in the 2.5 range. Relative sector weights plus or minus 4%, relative positions plus or minus 4%. You try to build a style neutral portfolio where stock selection really drives the excess performance. Bottom left is kind of a bar risk model. You'll see while some tilts do exist, they're very minimal. And then the right, I guess those are bar columns there. They're showing rolling excess 5 and year performance. Those are rolling since inception, or excuse me, since I believe it says 04, so the last 20 years or so. And those are rolling on a monthly basis, so you can kind of see how that excess performance has been pretty consistent over that time. And then Sherry, this is a performance slide, really kind of going back to those bars that Steve and David talked about earlier on the portfolio level. This shows the first two bars are ones that I really like to see. That's your Sharpe ratios and your information ratios, and essentially viewing that as what level of return are you getting for the level of risk you're taking. And this is a 5-year snapshot, kind of that market cycle thought. And you'll see that this product has been able to perform in top decile in those categories over that time. The up capture ratio, also close to top decile. That's going to be the third bar there with a 104. And then on the downside, still providing a little bit of downside protection at 97 there, which is kind of in that top third or so of investment strategies. This universe that it's being compared with has 270 other strategies in it, so ranks very well compared to their peers. Sherry, if you'll move to the next slide. T. Rowe Price, founded in 1937, also publicly traded. Firm manages about 1.6 trillion in assets with a strategy AUM of close to 90 billion. This is a little bit different. This is an analyst-driven portfolio. There's 28 industry specialists. They are managed by a 5-member portfolio oversight committee. This group of individuals has roughly 21 years on average investment experience, 9 with T. Rowe Price. From a product stability perspective, they've been able to add 7 clients over the last couple of years. This brings them north of 40, with net inflows of over 300 million during the time. Investment philosophy is somewhat similar to JP Morgan in that fundamental research is key. This is differentiated sources can create a competitive advantage. They're looking at company earnings and revenue. They believe there's opportunities for mispricing there. Investors tend to overreact to short-term news, which creates those opportunities. The team's really seeking to add value over a full market cycle. The short term, their belief is hard to predict what's going to be leading the market, and so really focusing on that full market cycle performance. From an investment process, the strategy is, like I said, a collection of industry-focused, analyst-driven portfolios. It's built from the bottom up, from stock selection. Capital is allocated across the analyst team in alignment with their coverage area, the weights within the index. Each analyst manages their own portfolio. They express their own convictions and their holdings based on that research that they do, looking at the business model, the quality of management, their position in the market, and the valuation. The portfolio oversight committee is a team of 5. They assign the coverage areas to analysts. They help to mentor and develop those analysts. They oversee their activity, and then they ensure adherence with the portfolio constraints and risk controls. You'll see that same bar model on the bottom left. Again, while tilts exist, very minimal. This portfolio is really attractive to me in that it's very style neutral. So if you look to the right there, that's a 5-year attribution. You see sector allocation really adds no value. It's a slight detractor. It's really all stock selection producing their excess performance. Sherry, if you'll slide over. Ultimately, the portfolio consists of 200 to 275 names. Relative weights are plus or minus 15 basis points, so much more constrained than the JP Morgan. Tracking error is about 1.75%, not quite as much tracking error as the JP Morgan product. Like I said, these people, T. Rowe Price in this strategy really attempts to be relatively industry and sector neutral. They do have a little bit of bands of plus or minus 100 basis points at the industry level, 150 at the sector level. It's meant to be an all-weather portfolio that's not dependent on any kind of style leadership. It's driven by individual stock selection. These 2 charts, I think, are really informative and point to that. You'll see that top chart's a growth and value market regimes and how they've performed during that. The bottom chart is whether the market's moving up or down and how they've performed in that. And what you'll see on their growth market, value market, up, down, whatever, their hit rate is 74, 75% or better. So they participate in all those markets. They've been able to add value in all those markets. And so that's a testimony to the stock selection driving the relative excess performance. And then I think we skipped one possibly, Sherry. There you go. This is kind of a performance snapshot as of the end of the calendar year. Again, the first 2 bar charts being that Sharpe and information ratio and how they've performed, what level of excess performance they've been able to do given the risk they've taken. Top quintile, the up capture ratio is strong, down capture ratio not quite as strong as JP Morgan, though still providing some protection in those down markets versus the index. Then if you'll move one more at this point, Sherry, this gets to the implementation and sizing. As of the end of the calendar year, we had about 400 million invested in that factor-based portfolio. That equated to about 3.3% of the public equity allocation. We think it's time to retire that investment strategy. It's going to be the primary source for these investments. We believe the allocation should be more meaningful in terms of its attribution to performance. So that's where we think the secondary source would come from the internal S&P 500. We believe that upsizing this allocation and blending the two finalists, the expected return can be improved while still maintaining the current level of risk in the greater portfolio. We think the strategies complement one another. They're both expected to outperform over a market cycle, but they do so with differentiated return paths. So T. Rowe Price, well-diversified, large number of incremental bets that compound over time. JP Morgan takes larger relative positions. This creates opportunity for greater excess performance. At the same time, it's going to be at a little bit higher level of risk, so the return path is a little less predictable. But by blending the two, we think we can get a higher expected return, yet a smoother path of those returns. The correlations between these two strategies are about 0.5, far from a perfect one, which means we're not doubling up on any one particular investment idea or bet. We are asking for a little bit larger approval, so we're looking for about up to a 12.5% of the public equity portfolio with the initial funding of approximately 6.5%. You'll see what that approximately equates to as a dollar amount as of 12/31. Obviously, the markets have moved since then, but that's roughly the sizing per plan. And then, Sherry, if you'll go one more for me. We're recommending both staff and consultant believe that JP Morgan and T. Rowe Price will be a positive addition to the public equity allocation and therefore an extension of the investment program at KPPA. While they're distinct in nature, they do share a philosophical belief in conjunction with the differentiated construction methodology we believe yields a complementary return profile. Neither relies on style biases or tilts, but rather on idiosyncratic stock selection to drive relative performance, which we think helps insulate the portfolio from any macro theme influences. The expected results of a more efficient global public equity portfolio with a better risk-reward profile and increased diversification, as both these strategies have low to negative correlations with the existing strategies within our public equity allocation. So with that, we're recommending the JP Morgan U.S. Large Cap Equity Strategy and the T. Rowe Price U.S. Structured Research Equity Strategy, up to 6.25% of the public equity allocation, with the initial funding, like I said, around that 3.3%, or approximately 385 million, wherever that math comes out. The primary funding source is going to be the scientific beta internal factor-based portfolio. Any incremental dollars would be coming from the S&P 500 portfolios. And that kind of concludes my prepared remarks, if anyone has any questions.
Yeah, first, I would just like to commend Joe. This was a huge undertaking because the starting point was really that side beta portfolio. Is it something we should continue to invest in? As Joe says, time to retire it. And again, it looks, when we have performance reporting, we've been comparing it to the S&P 500, which is probably not the appropriate benchmark for the portfolio. So its relative performance looks worse than how we actually evaluate it. There's probably a better benchmark we should have used for it, but really is, given the makeup of that portfolio and the strategy, is it something we continue to have conviction in? And so that was the first determination. The second was then, what would we replace it with? And even when we got to the point of looking at these, I think the initial thought was we were looking for a single manager, but to Joe's credit, he expanded that and said, if we add multiple managers to this pool, how does that affect the risk return profile? Would they potentially complement each other? So arriving here was a very long process. Obviously, Wilshire helped out quite a bit on this as well. So if they wanted to comment, but I see Ms. Bova has a comment, a hand up as well.
Sorry, just my typical questions. How much do they cost?
Fees, yes, I should have mentioned that. I apologize. So the T Rowe price is offering a 24 basis point flat fee. In discussions with Wilshire and some surveys that they've done on strategies like this, what's an appropriate fee level? 24 basis points is kind of that cheapest quartile. So I think it's very reasonable. The JP Morgan product has a little bit more active risk in it. As such, they offered 28 basis points after some discussion. They actually have a portfolio in a strategy in our portfolio on the EM side. So they're also offering relationship pricing, which brings that 28 down to 27, just outside of that cheapest quartile for a strategy like this. However, the emerging market portfolio would also be subject to that relationship pricing and should bring 3 to 4 basis points off of that fee that we're already paying for that strategy as well. So there's some fee savings that if I did the math, that 27 would come down. I haven't done the math because it's going to be saved over on the emerging market side, but very reasonable given the strategies, their success, and like I said, kind of in that bottom quartile as far as fees. I don't know if Craig or Dave Lindbergh wants to add anything to that, but I think it's an appropriate for what we're getting here. So,
And what are the fees that we're taking out of the
scientific beta is
not the scientific beta. I understand that strategy, but the S&P 500, the internal management is what's the cost
internal
of
management.
managing that?
I mean, the fees are basically the FactSet licensing that we do. I haven't done that on a basis point, but it's going to be significantly less than one. My time. The scientific beta one, I did bring that up because there is a fee attached to that index that we utilize of a flat 6 basis points. So while yes, incremental fees are going up, the 24, if you were to think of that, becomes 18 from a net perspective, and if that makes sense, we're already paying 6 basis points to license that index that we'll be replacing.
Okay, so other question would be what sort of, and I know that I think Victoria gets into these details, what sort of contract are we signing up for with them, with these two funds?
Well, it would be ideally we would start with, if you were to go to our website, you'll see the investment management agreements for the public equity portfolio. So we would start with that as being the base. It would be in perpetuity or an evergreen.
My question is, like, if in a year from now we decide we don't want to do it anymore, can we just get out?
Yes. So
Okay, no penalty.
there is always a termination clause in those agreements that say essentially we have the right to liquidate the investment. So
With no penalty.
no.
Got it.
Correct. It's usually a 30 or a 60-day, sometimes 90 days notice, so that
Typically we've done 30 days and the manager's been fine with that. These are long only, very liquid strategies. So and then of course there's daily liquidity if we for whatever reason needed to raise funds or whatever. There's no issues with that. So
Yeah,
And
we
no
can- we
cost to
can-
get out of the scientific portfolio, scientific beta.
correct. Just the notification period. So
Gotcha. Thank you.
Wilshire, was there anything you wanted to add on Joe's recommendations?
I just wanted to chime in and say that the process Joe talked you through here, as you said, Steve, was extensive and very well thought out, very, very robust, as you could tell from Joe listing all the different steps. And this is something that's been monitored in the background. I'll give Chris Tessman, our team, credit for doing most of the quantitative heavy lifting here, back and forth with Joe over a number of years here, and really stepped it into high gear to push it over the finish line here. And I think you end up with a better solution from a overall portfolio perspective, not having a pervasive tilt, allowing the value add to come from these teams that have proven an ability to to root out the winners versus the losers.
And I'll just add one more piece. You know, the large cap US equity marketplace is the most challenging one out there. We believe it's just the hardest one to win in. And so fees are a big focus. I'm glad you asked about those. And we feel really good about the fees Joe outlined for these two mandates.
Any other questions or comments? Then I guess we will I will look for a motion to approve the contracts for JP Morgan and T. Rowe Price as Joe has laid out.
Do we have enough people? Are we doing motions? Yes.
Yes,
Yes,
I'll make
have
the motion.
3.
thank you, and I'll second that. And I guess I believe we do need to vote on this. So with the motion that we approve the JP Morgan and T. Rowe Price contracts subject to legal review as for the strategies as presented today. All those in favor?
Aye.
Aye. So I believe it's unanimous. We have three ayes there, so that is approved. Thank you.
Thank you.
Thank you, Pruitt. I believe the next is Anthony Chu with the real return investment recommendation.
Yes. Hi, everybody. Thanks. I'm here to recommend an additional investment with an existing manager. Share, if you could go to page 207, please. A couple years ago, you all approved an investment with Arctis Sports Partners. And our idea in investing here was to get exposure to the big US sports leagues, which are I'll say well run and basically have enforced profitability, given that they have or for the most part with salary caps and centralized revenues, along with, of course, team specific contracted cash flows that they can affect and impact for their own valuations. Since then, they have deployed meaningfully across the U.S. sports leagues in some very interesting and unique deals that they were able to create with some of the control owners. Again, kind of doing what we thought they would do in terms of being good partners with these folks, not just being money, but also helping in terms of adding value on in the venues and also other investments around the franchise. So, and then of course we were hoping that they would have exposure to the NFL, which of course stands out among the sports leagues as the largest and the most with the most revenue and the most attention. And that finally did happen in late August last year. The league did follow the rest of the sports leagues and allow private equity investment into their teams as in minority stakes. Of course, they did their own way and had a few other restrictions as well. Some limits on how large of a stake they could take, how many teams you could invest with, and of course, requiring you to be institutional enough to be able to participate. So over $2 billion of committed capital, and so that was approved in August. They approved 4 groups. Arctis was one of them, and then the earliest they could do a deal was in the owners' meeting in December, which is when 2 deals were announced. Arctis invested with the Buffalo Bills. Ares did the similar investment with the Dolphins, and so this is to get some approval to invest directly in an NFL focused vehicle for Arctis. This is a vehicle that will be able to invest in multiple teams. So I think originally it wasn't clear whether how things would be approved or structured. Since the NFL actually has a more centralized revenue than all the other leagues, there isn't quite as much differentiation between the teams because the media deal is so large and it's shared among all the teams. But there's still ways for individual franchises to add value, and so they've been targeting many of the franchises and have active discussions with them even long before this approval. So we can go to, let's see here. We can go to page 211. Yeah, so you can see here, again, this is, unlike most sports leagues, have performed similarly to the chart on the left with the blue line. The NFL has been even stronger than that, but they have outperformed the regular public markets. They've continued to grow their revenues, but through media and also ancillary areas. And so if you go to page 212, the next page, Sherry, please. Art does provide an interesting slide that kind of shows the correlations of the valuations and the returns that the league has had versus some other regular way asset classes that we tend to have in our portfolio. And like a lot of things we like to see in a real return, this is going to be something that's different and going to provide different exposure for our portfolio that won't move with public markets, which is obviously the majority of our exposure. The next page is 213. Obviously, I think most people are familiar with the NFL, and the passion that it inspires. They may not know as much about some of the attributes on the left, which shows some of the structures that they've put in place, obviously, in terms of labor and the regional areas that each team gets to have, and how that enhances the value for all of them. Okay. So if we go back up, we can go to page 209, or sorry, 208, please. So, I think some concerns sometimes are the valuations, because obviously they've gone up even significantly, even during our underwriting process and our investments so far in Fund 2. A lot of that is driven by the media rights, which continue to rise. I think that was probably one of the main concerns I've always had. It's like there's only so many people who can pay for these. But I think Arctis has done a good job showing that actually it's more of a two-way street. Like the media folks actually need live sports just as much, because that's what brings subscribers for the streaming side, or just eyeballs period for the linear TV networks. So if you look on the chart in at the bottom half of 208, you can see just in the past 10 years how much scripted and general entertainment has gone down on your regular networks, whereas sports retains that, even though people have cut the cords and don't watch as much linear TV. Similarly, the NFL, above all other leagues, is the source of almost all the top broadcasts in America every year. Of the top 100, almost all of them are NFL games, with the exception of the Macy's Thanksgiving Day Parade, or the Oscars or something like that. But almost over 90 of the top 100 are NFL games, obviously with the Super Bowl that we just had being the top one. If you go to page 209, this also just shows, compared to the other leagues, the difference in terms of the revenue and the power of the brands and the franchises that they have compared to other sports leagues, which are also scarce and also valuable, also have contracted revenue streams of their own. But the NFL is a unique asset, and its franchises are as well. And so that's one of the reasons we are interested in recommending an additional investment here to get exposure to the teams rather than the whole fund. And so if you go to the next page, 210, this is that you can see how the performances has been marked so far. Our fund has pieces of the Utah Jazz, the 76ers, Devils, Dodgers, and the Warriors among the positions in our portfolio. The Arctis 2 is going to take position in the NFL fund, so we will gain some exposure to the NFL teams in that fund through that. We're also going to use a little bit of our co-investment that was approved by you all. That will be fee-free, and then our additional investment will have basically the same fees as Fund 2. There will not be double layer fees. Obviously, you can imagine that could happen if Fund 2 invested in this fund, but that's not what's going to happen. Actually, this additional investment will also trigger a fee break, kind of like Joe was saying, for his managers. This additional investment would put us into the next fee tier for both, and they've agreed to reduce the fee for both this fund and also the remaining part of the investment period for Fund 2. So the fee break will apply going forward for both commitments. I'm happy to take any questions that you guys might have. And yeah.
And just stepping back and framing, so
Mhm.
when we originally and when Anthony originally presented Arctos Partners, that
Mhm.
so the NFL was not approved yet,
Mhm.
investment in the NFL, and we anticipated that it would be, and that was a big reason that we really liked the investment opportunity. And this is how the structuring has come out. Exposure, as you mentioned, through Fund 2 will be pretty small to the NFL. So our conclusion was we wanted original thesis of the investment was we wanted part of our exposure across all of the major sports leagues, including the NFL, and the way to achieve it, given the structuring nature required by the NFL and what Arctos is doing from a fund perspective, requires a commitment to the new AAFF. So it's consistent with what the original presentation was and the expectations as far as exposures to the major leagues from a total overall exposure perspective.
Ramsey, I believe you have your hand up.
Yeah, so my general, I do not know a lot about this. I do not know anything about the NFL, but my general experience with sports teams is that this is very basic. You have like a billionaire that buys a sports team and they invest a lot of money in it and they own it. And then, well, there's going to be more costs that are required. We got to replace the field. We got to do this. We got to do that. And they're like, well, I've already put in 5 billion. I'm not putting any more in. Let's go raise some money through private equity. Is that what this is?
There is some of that. So like the Bills actually are building a new stadium right now. And so but the costs are also in this case going to be borne partially by the public. But yes, that's some of the things that Arctos can add value with. They did specifically for Utah, which is in Fund 2. For us, they helped them with their real estate as they were trying to manage whether they would stay in downtown Salt Lake or perhaps relocate in that metro area. It was a 2 or 3 year process that they've been working on that. And then through that process, they were also able to help them gain control of the Phoenix NHL franchise, which they moved very quickly last year. Over between in less than a year, basically from the end of the season till the fall, moving a team, getting it all stood up and everything very quickly. So they're an integral part of that. And so yes, it is. These are folks who are going to be who do need growth capital as well, but that's part of the plan and part of the value add that Arctos brings.
And does Arctos represent, do they have any fiduciary obligation to us or any other owners or investors?
Sure,
And
yes.
towards transparency of fees?
Sure, the fees are, I mean, they're going to be subject to the same parameters that we have for our managers since I think Senate Bill 2 was passed in terms of we need the ILPA templates and reporting that we
I guess
have.
my
So,
question is, so like the investment is not, let's just say
Mhm.
Cincinnati Bengals
Sure.
so someone owns that.
Yes, there's a
We're
control.
just investing in a fund that's going to invest in that.
Mhm.
But
Yes, it did.
I guess where's the conflict of interest between the fund? What if the owner of the Bengals says, well, I'm going to buy a new stadium and it's going to cost $2 billion. Where does that put the Kentucky pension in terms
Sure.
of that obligation?
Well, I think that Arctos would probably be pretty involved with them in terms of figuring out how to finance that. And to the extent some equity being needed, that could be part of the what the fund would contribute. But that's the folks they're partnering with are obviously have made a lot of money themselves. A lot of them these days are folks who've made their money recently in business, and so they're looking to expand their franchises and values and get facilities built. Another example right now is the 76ers. I think they've recently got approved for a downtown arena in Philadelphia. So that's something that, again, Arctos is working with them on.
So if there's like public funding that goes on with that, does the owner of the team get the public funding, or does Arctos get some benefit from that?
They'll benefit from the increase in the franchise value because they're minority
But
owners.
no direct benefit.
Direct in terms of how?
They don't receive
so-
funds, no.
No,
They don't.
no,
No.
they won't. No.
So you're like, Okay, go
And
ahead.
maybe I can help Ms. Bova on this. We have a limited period in which they can call down money.
Mhm.
So we are doing an investment of up to whatever the dollar sum is. Anthony, I don't have it right in
100
front of me.
million in this case.
Okay, up to 100 million, and they have
Mhm.
a 5-year period, I think, in which to call that down. So any investments that are needed during that time period, as you're saying, like if there's going to be, the owner decides he wants to have, like a new building, if that is still part of the money that can be called down, then we can be asked our share to, go to the fund to do that. But after that period of time, there is no further call down from this fund. So the owner would have to go find, some other funding if it's not within what's readily available. So we're not on the hook for anything above the $100 million that we are putting into this investment.
Okay, so let's say just on relation to that, if we put in 100 million and the owner says, okay, I need 50 million for a new jet, we're in?
So what,
No, I think the fund would have like the GP of what it actually can invest in. So it's not like to just benefit the owner directly. It has
Well,
to
what if he
be
says, I want to fly the players around? I mean, I guess
So-
I'm just trying to figure out where's the line of, who's making the decision on behalf of the participants in our pension plan?
So
That's
what
I'm
they're
trying to figure
purchasing, what the fund is purchasing is ownership stakes in the teams, right? So it is for 5% of the Cincinnati Bengals, they're paying X millions of dollars. That becomes now they are an owner of the team. Anything if the owner wants to raise $50 million to go buy himself a private plane, he could sell more of his stake in the team to raise that capital to fund that himself, but that's not something the fund is going to fund on his behalf.
How do we know that?
Well, because what they're allowed to purchase is they're allowed to purchase ownership stakes in the teams. So they would have to the transaction would have to be they would have to sell additional shares, ownership stakes within the team, and that's the asset they would buy.
Okay, and so we would be like a limited partner.
correct.
Yes.
Okay, which is not proven in the past to be very successful because it really gives us no power. I mean, no authority to get in and out as we want. That's
This
not
being right, this being private equity, it's a lockdown period of time. It's not the public equity where you can get in and out. The in and out is selling on the secondary market if we ever needed to.
which has not been an effective strategy, just based on my history.
Right, that
So-
it's usually at a cost, you need to get
Yeah.
out on a secondary market.
Okay,
But that's something that's developing in this market. The Arctos folks actually have a secondaries market background. So that's some of that's part of why they're able to provide the solutions for the owners. So some of the transactions do have some growth capital elements of it, and some of them are also to provide liquidity for other minority owners who need liquidity. And so that's something actually larger that Arctos is building, kind of where capital markets function within. Since the sports landscape is not, it's only so big. And so if you know all the people and the players and can facilitate transactions and meetings and solutions for folks, that's something that they're in the middle of and have hired a couple people to start doing. And so I think eventually that will be another way that this becomes a little bit more liquid. And that's definitely something that is, important for folks because these are liquid assets. Yeah.
I think one of the reasons that the NFL finally was the last player to come, pardon the pun, to come aboard is that the average age of an owner in the NFL is in their 70s. So they have divorces, they have estate planning, they have things that they need to have solid valuations on. Arctos, by putting its money in, or the other partners, provides a real value because there was a transaction there. And I think that's what it's not like Jerry Jones is going to call Arctos up and ask about trading for a quarterback, which they should do. But the business side of it there's a need as a big asset for what Arctos brings, or Ares or the others bring to the table. And I will say that I think there were lots of people that wanted to have access to the NFL, and there were only 4 that were given that access, including Arctos and 3 other private equity funds. And I from the list I saw, there were 50 multi-billion private equity funds that they told to go take a hike because Arctos had a good reputation for working with these owners in the league.
That's right. And actually, Chad from Marcos did play for Jerry Jones briefly. But yeah, I mean, they're obviously not there to advise on football. They're there to advise on value of the franchise. But the relationships, like you said, Pruitt, is important. They have connection with, almost all the franchises that you probably want to be connected with, and have had these discussions have been having some discussions for at least a couple of years, and then now more, of course, now that things have opened up. So.
David,
this is
have some thoughts
from the NFL perspective. This is certainly baby steps, right? I mean, I think this is the pathway is different. And one of the, as Pruitt kind of mentioned, given the valuations of teams and the restrictions on ownership, the pool of people that could be involved was pretty limited. And this has broadened that pool. And to Anthony's point, that's also increased the ability for transactions. And we were on the phone with Arctos, I think, was that last week, Anthony, talking about some interesting opportunities in secondary, and that's where maybe minority owners or are looking to exit. And so I think you'll see transactional activity increased based on the loosening of the restrictions. They're going to be very prudent in it, right? As Pruitt mentioned, they limited who could participate initially. There's probably some broadening of that market over time, and then it becomes a little more transactional.
David, you have your hand up. You're on mute.
Sorry, just want to check in. I would be a no on this. So just wanted to let people know that in advance.
So is there anything
I'm leaning that way too, sorry. But I'd be happy to do a call like we talked about afterwards.
Yeah, and David, we're happy to talk with you too if there's anything you'd want to know more about, or if that's how it is, that's okay too.
Yeah, some of my concerns are just the business model of the NFL. It benefits with a disregard for the health consequences to the players, create the wealth for the owners, the shakedown of public funds necessary to pay for these billionaires, multi-billion-dollar stadiums now. It's just not something that I appreciate the value. I appreciate the value of the brand, but a private equity arrangement, there's just too many strings here. And to me, the NFL is not the kind of, they haven't shown themselves to be the kind of place that I would want to put public money. And I realize that is to some extent a judgment call, perhaps not based specifically on the financials, but this just doesn't pass the smell test for me. So that's where I'm at.
Well, we can do one of two things. We can vote for it now, or we can defer and maybe have a little more education or discussion, or and vote on it later. So and I'm leaning to for it for the investment. So, but I hear other positions here and respect them. So I'm thinking that if it's all right with the committee, because I'm going to ask you all to if we defer voting.
I would like a further discussion, because I think we have approved this in previously. So I think it definitely calls for another discussion.
Okay. So we'll defer voting on this position and study it in greater depth.
Okay, thank you very much. We'll get that scheduled and figure it out.
Thank you, Mr. Chair.
So Pruitt, I think the next is the investment policy statement performance benchmark recommendation, and that's Joe again.
Before we go to that, Mr. Lane, because you have a quorum now, did you want to go back and vote on the minutes?
Sure. You lawyers never miss a beat, do you?
I
I'll-
move approval.
Second,
I vote for it, so I don't think consensus is that the minutes of the meeting September 21 and what are the other November were to be approved.
aye. Oh,
Thank you.
Okay.
Okay. Sherry, if you'll go to 214, I believe. So, we're coming to discuss the public equity benchmark being utilized. Kind of Steve gave a slight preview earlier in the meeting, but currently we use the MSCI AcquiNet as the public equity benchmark, and staff and consultant have determined that we don't think this is represents our current investment exposure appropriately and embeds some unintended biases between our portfolio and the benchmark itself. We're recommending adopting the MSCI ACWI IMI as the benchmark represents a better alignment of actual exposure and strategy that we think the board desires. A little bit of history prior to the current IPS, we targeted both US and non-US, and as such, we use regional performance benchmarks. You'll see in that chart, middle of the page, it kind of gives you a little bit of the history. But with the adoption of the April 2022 individual targets to US and non-US were removed in favor of a more global exposure. And so with that, the adoption of the MSCI AcquiNet index was prescribed by the IPS. We've attempted to manage these changes utilizing the existing roster of investment managers and strategies in a way that provides that global exposure. We think we've done so successfully, and we've done so with the desire to aim at minimizing any direct or indirect costs with any significant portfolio turnover event. There's a little bit of an issue that's kind of come up from a relative performance perspective. While deviations are going to occur regularly due to tracking error, either through the introduction of active management or actively positioning tilts from a tactical perspective, either style, regional, market cap, whatever that might be, those deviations should be able to be attributed to a known source. The recent market environment of large cap dominance and the degree of the relative performance deviations couldn't fully be explained by the identifiable performance attributes and our positioning. So this prompted staff to initiate an investigation into the appropriateness of the current benchmark being utilized. Historically, like I said, given the legacy strategies and the asset class categorizations, we use the Russell family for the U.S. side, the MSCI family for the non-U.S. side. If referring back to that little table of benchmarks, you'll see that we used the Russell 3000 and the MSCI ACWI ex-US IMI for those US and non-US allocations most recently, as we thought those provided the broadest definition of the investable universe. With the recent IPS adoption of the MSCI AcquiNet, it created what staff believes to be an unintended structural small cap bias within the portfolio, embedding an additional or an increased level of tracking error. This really surfaced most recently due to the performance deviations between the US market cap. So for instance, 2024 large caps produced roughly a 25% return, while small caps produced an 11.5% return. So that deviation really came to the surface in our relative performance. With discussions with MSCI, with Wilshire, through those discussions, we confirmed that structural bias is there, that the MSCI AcquiNet doesn't really cover the bottom 15% of the market universe. If you look, I think it might be on the next page, Sherry, there's a line chart or graph. No, I'm sorry. Go back up one. There you go. If you look there, this depicts what the shift and tracking error would be had we employed the MSCI ACWI IMI. It's a mouthful there. And what you see is tracking error decreases across that time, most recently by as much as 40%. A tighter tracking error is indicative of a more appropriate benchmark given the portfolio's exposure. So, like I said, staff and Wilshire recommend that the IPS performance benchmark of the global public equity allocation be changed from the ACWI net to the more appropriate ACWI IMI. This will expand the investable universe of the benchmark to one that's more appropriate given the exposures and of the strategies within our portfolio. If you do slide down to that next page, it kind of shows you the difference in the performance benchmark. So where Steve made the comment in that 1 year, the relative underperformance we've experienced, over half of that is due to this benchmark mismatch where the existing benchmark we're utilizing doesn't have any small cap exposure like we do within our portfolio. So that's a good part of that relative performance. So that structural bias has been a headwind for us this last probably 18 months, really. Longer term, typically you're going to see the two different indices perform more in line with one another, but it opens us up to short-term deviations in relative performance. That's just potentially significant headwinds. That's not the most appropriate way to manage the success of our portfolio. So that's the recommendation. Happy to take whatever questions you might have.
Wilshire's also opined on
Yeah.
recommending this change, and I'm not sure if they want to address anything additional.
Yeah, we have a memo in here that really mirrors the staff memo that Joe just went through, and I think the point really is that the IMI stands for Investable Market Index, so it broadens the index to include small cap. MSCI has their own definition of what's investable based on the different markets and the level of float and how tradable some of these securities are. But essentially, we want the broadest possible index to reflect the opportunity set and to reflect how the portfolio is implemented. And as Joe said, when we look at attribution and relative performance, if we don't have the best possible index match, there's too much noise in those numbers to really easily be able to extract what's driving performance. So this move would give you an index that's more representative of the opportunity set, the portfolio as it exists. And it's not, I know whenever an index change comes up, the first thought might be, are you trying to give yourself an easier hurdle or anything like that? You can see here that in the short term, the IMI, because of that small cap underperformance, is easier to beat, but want to assure the board member, the IC members here, that the intention here is really to have the best possible measuring stick, not to have something that's easier to clear. It's just a coincidence that in the shorter term, small cap is underperformed. We would expect that, as Joe said, to primarily come out in the wash, so to speak, longer term. But there's this short term period of noise that we can experience when small and large cap deviate significantly.
Right. And to Craig's point and to comments Steve made earlier in the call, as the market broadens out here in this here recently, where small caps have been outperforming, you could envision a period of time where small caps significantly outperform large caps, and we have exposure to them that the benchmark wouldn't be under the current scenario, and all of a sudden we look really good. And again, it's due to a mismatch in that measurement stick, and so we want to be as accurate as we can with the benchmarks we have. And so this is an attempt to true that up with the exposures that we invest. Oh, lots of questions.
John. All right, Ramsey.
Can you just summarize what is the question?
Well, the question is just looking for your all's approval to make that change from the MSCI ACWI Net Index to the MSCI ACWI IMI, as we believe it's a broader universe. We want to be as diversified as we can. It's also indicative of the exposures within the context of our public equity portfolio. So we're removing a structural bias against small caps that has been a headwind for us in recent performance, but potentially could be a tailwind that we don't necessarily deserve credit for. And so we're just trying to align the most appropriate benchmark given the exposures that we have. So
I agree
Sherry,
with
can you
that.
turn to
If-
page 42, please? Sorry, Ms. Bowman.
I was just gonna say, if you all think that's the right thing to do, I agree with it.
Yeah, I think that with the changes, as Joe mentioned, with the change in the IPS, the IPS used to have a specific allocation target for U.S. public equity and non-U.S. public equity. And given the performance benchmarks in the IPS that were used at the time, we did have that broad opportunity set, including small cap with the Russell 3. When
Right.
that switch was made to the MSCI ACWI net, it essentially from the benchmark excluded the small cap population from benchmark. Although we as a system still invested in that small cap universe because we think it's appropriate from a diversification standpoint and what the opportunity set is. So that's really just we're asking for the performance benchmark in the IPS to be aligned with the management of the portfolio.
John, do you have a question?
Yeah, I do. What's the effect of this change when comparing to past performance? You're changing the metrics on that. Is there any, how's that
So-
end?
Well, that's something Steve and I need to discuss some, but our actual performance doesn't change at all. It is what it is. There's no change from that. The relative performance, it would be on a go forward basis for sure. I don't know that that's something that Steve and I still have just not necessarily clarified, but Steve, I don't want to step out of turn, but
No, I think the effective date, John, your question is what would be the effective date? And it would be changed. Historically, it would remain the same, anything prior to that effective date. If we made an effective date, we would change the benchmark, the performance benchmark for a period going forward. Whether we wanted to do it for the fiscal year, I think that the impact is relatively minimal, correct, Joe? It's kind of the period before the start of this
on the
fiscal year.
there's only 4 basis points difference between the two benchmarks, so it's not going to have a relative performance impact. So
Yeah, it was more about probably the last 18 months than it was the last 6 months of impact. So if we made an effective date of we could do the start of this quarter or the start of the next quarter as to the effective date of the change, and then it would be go forward, that's where we would be measured against. Historically, it would remain the same what it was.
Thank you.
You're welcome.
I think that's a fair way of treating it. And in general, the whole subject of how indexes are actually managed is in the discussion. There's some people that believe that S&P has a committee of 3 people that make a decision that has an impact on performance, not on or the relative performance. And is that really the right and efficient way to do it? So, but I'm glad that the team has identified this issue, and I'd like to get a motion to approve from the change of the benchmark from the ACWI to the ACWI IMI.
I'll make the motion.
Second.
Second, thank you. And would like to vote on this since it does affect the investment policy. All those in favor, please say aye.
Aye.
Aye. It's unanimous. Thank you very much.
Thank
Thank
you.
you.
And Pruitt, I believe the last section is the investments compliance review, and Ms. Carrie Bass, please.
Good morning, just barely. I'll try to be short and sweet. I am Carrie Bass. You may have seen me previously in my role in the Office of Legal Services, but as of November 1st, 2024, I transferred to the compliance officer position at the KPPA, and I will be bringing you your quarterly investment compliance report going forward. Next page, Sherry, please. First, we're going to start out by covering the guideline compliance review. All of the guidelines were in compliance for the quarter ending December 31st, 2024. Next slide, Sherry. There's a breakdown in the materials provided to you in board book of each of those compliance guidelines. And as you can see, each is marked as being in compliance. Next slide, please, Sherry. Just a refresher on what those guidelines are. Those are the yes or no requirements contained within the Kentucky Retirement Systems IPS and the external and internally managed portfolios. We're going to be looking at the entire quarter. So if any of those guidelines fall out of compliance within a given quarter, you'll see an out of compliance finding on the report. And then you'll additionally be given information in the compliance report on the guideline that was out of compliance, the date the exception began, what caused the exception, and information on the resolution. The KPPA team is continuing to work with BNY to provide additional enhancements to the compliance reporting, and we'll bring those to the investment committee as they become available. And then the second part of the report is going to briefly touch on asset allocation compliance. You've already seen that information previously discussed in the material. There were no asset classes outside of the allowable range. Next slide, please, Sherry. During the quarter ending December 31st, 2024. But going forward, if there is an asset class that's outside of the allowable range, you will be provided with information, including the date that asset class was outside of the allowable range, what happened, and the resolution. Any questions for me?
David,
Mr. Atkins.
Yeah, I just wanted to confirm, because I think I had some trouble with the reporting relationship with your successor. But does this report represent your independent judgment? And has it been reviewed by anyone in the management or senior leadership structure of KPPA and modified in any way by any of those folks?
This round, I did work closely with Mr. Riller since I was taking over that responsibility from him. He kind of was preparing these reports in between the compliance officer position being filled. But moving forward, yes, I would say there's a great deal of independence. For the first part of the report, the guideline compliance, is primarily relying on BNY's kind of independent assessment of reporting on whether or not those guidelines were in compliance or not. And same thing, I think, with the asset allocation. There's an independent source for that information that I am reviewing and compiling for this committee.
Yeah, I guess my admonition here is that my preferred expectation would be that this position is more like an internal auditor with a direct reporting relationship to the investment committee on or reporting on compliance. And so to the extent that there is any influence, particularly any undue influence or lack of resourcing for this independent analysis, that's something I would encourage you to feel very comfortable reporting to us. And I say that with no suspicions or notion that any of that has been the case. In fact, I have every reason to believe that this function is supported as an appropriate part of oversight. But I just want to reaffirm that this position is very important to us as citizen board members, to make certain that to the extent that this accountability function is maintained in-house, that it does have an independent status although I know it has to fit into the organizational structure for administrative purposes, I would not want its substantive functions to be influenced by senior management unless all of that was disclosed to us. So that's just my thought as you're new to this position.
Mr. Atkins, I think that's a great point. The compliance officer used to sit outside, did not have a direct reporting line in the Office of Investments. The prior CIO moved that position into the investment office. Our recommendation has been to remove the compliance officer out of investments. So exactly to your point, I think whether it's optics or not, I think it's inappropriate for that reporting line to be through me. Given it's an oversight function on my staff. And so I think the proposal has been made that Carrie will ultimately report to Mike Lamb. And with, so the interaction is when she identifies an issue that's not in compliance, she obviously will have to work with investment staff to determine the cause,
Right.
To make sure that it's a valid exception, it's an actual compliance issue, and what the resolution is going to be. But I would agree, we don't want to certainly exert any undue influence on her. And I don't think in this report we have. I think she would be happy to tell you that I didn't tell her to change anything as far as compliance status with any of the measurements she's made.
And I concur with Dave's position and how important David's admonition, I guess we call it, but that it's very important to protect us that, in case someone wants to bring a lawsuit, what a crazy idea against the board members of the fund. I think, and I think Mike Lamb's going to make a comment here in a second, but I think that's the proper resting point, if you will, for Carrie's position, rather than the office of the chief investment officer. Mike, did you have a comment?
Steve covered it, but basically, yeah, the plan is through our reorganization legislation, is to move that compliance officer position under the Office of Financial Management, assuming it passes the House and the Senate this session.
That's great. I appreciate that. And then on the substantive report, I just want to commend everyone who has gotten the investment allocations within range. We talked about that several years ago. There has been a focused effort to get there. And I want to commend everyone for bringing that into compliance, which a lot of folks would say, well, what's the problem making that happen? And we all know that, particularly with private equity and when you can make the investment and when it's actually the funds are put to use, timing is a very complicated thing. So I think in relatively short order, to the accolades to the staff for making that happen, getting that in compliance is quite a accomplishment, and I don't want to have it gone unnoticed that there's no exceptions noted there. So thank you.
And if you'll remember, David, a couple of things, as you pointed out, we in these I won't call them difficult, non-mainstream asset classes, to go from let's say 8% to 12% overnight was unrealistic.
Yeah,
and the board was very helpful in going along with those changes. And not that we're hiding anything, but you just can't get and you're just setting yourself up for being out of compliance. And once we've gotten those fine-tuned a little bit, I think we'll be in great shape.
Yeah, I think it was done very, very prudently. To just do it abruptly would have actually lost money for us. So
Sure.
I think very well managed.
Okay, I don't believe we need to vote on this one, but we do appreciate the review and welcome. We've known Carrie was here, but seeing her and the format of this report and
Mr. Chair, I'm sorry to interrupt, but given what I would encourage to be sort of the independent relationship, I guess my suggestion would be that as a regular practice, we would take a vote to accept the compliance report as sort of a tacit acknowledgement that it is a report to be received by the committee and adopted by the committee outside of just a reporting relationship.
I think that's a good idea. Are we allowed to have an additional voting item on our agenda, or is that outside of our purview here?
Mr.
No,
Chair,
It's listed on the agenda, so any item on the agenda you can vote on. And even if it wasn't on the agenda, this is a regular meeting, so you could have added things. So yes,
Okay.
you can do a motion to accept this report.
Well, I'm gonna accept Mr. Atkins' recommendation that it becomes a voting item on our investment committee reports going forward. And if I could get a motion on that,
I would so move.
and we have, and I'd like to vote on that. I think it's important enough to all those in favor of the investment compliance review being a voted item on our approved item on our future investment committee reports, say aye.
Aye.
Aye. Okay. The motion passes unanimously. So,
And then Pruitt, to follow that up, I would move that we accept this specific report.
okay. We can just note that in the minutes. Is that okay?
Well, the first motion was to say that this needs to become a regular item
Okay.
without accepting this particular report. So I would just say we need to act on the particular report in addition to the previous motion, which said going forward, we need to approve these.
That's a good point.
It's once, but
I will, would you like to make that motion?
so moved. Thank you.
Okay. And I'll second that. And all those in favor of accepting this review for this meeting, I'll say aye.
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 Aye. Thank you. The motion passes. Okay, and then we have a very popular item coming up next. Is everybody ready for lunch? We used to get these wonderful Panera sandwiches for lunch at this point, but
We've improved investment returns by not having hospitality largesse spent on the board members. A very good strategy on the investment committee.
that and the coffee consumption in the in the boardroom. But I will move that we adjourn this meeting, and thank you all very much for a very good attention and to and the staff. I commend them for the work they brought to this meeting. Thank you.
Sure.
Thank you very much.
Bye.